When someone starts a business, they need to decide what type of entity they want to operate the business under for federal income tax purposes. There are several different types. You could be a sole proprietor, you could be a partnership, a C corporation or S corporation, could be an LLC or nonprofit. Sole proprietors are the easiest ones to establish. Depending on the type and what the county says, you may need a local business license. Otherwise, you don't need anything. You can go out and start your business, sell or service or whatever it is. A partnership is a little more complicated. It can be simple. You can set up a partnership even verbally. It doesn't have to be in writing, but it can be just a verbal agreement between two people. You want to start a business. Again, you get the local business license and start your business. You sell your product or whatever. You split the profits the way, however you decide you want to split them. C corporations are a good idea if your business could, if there could be some liability issues. If you have clients coming to your location, you have potential to slip and fall, or somehow they get injured, or if you're selling some sort of product, there's a possibility that they could get injured, or you could somehow be subject to some sort of liability. Then you would want to be a corporation. That would it's more of a legal issue, but it's a limited liability thing. There are some tax advantages of corporations versus sole proprietorships. You could be an LLC, which is a different type of entity. LLC stands for Limited Liability Company, Limited Liability Corporation. That is a designation with the state. When you set that up, it limits your liability, just like a corporation. Otherwise, it can be operated sort of like a sole proprietor. Then, of course, if you are a nonprofit, you could set up a nonprofit organization with the IRS. That's a little more complicated to set it up initially.